Welcome to Talks with Dr. Gupta and friends. Every year, thousands of India's most successful entrepreneurs, investors, and high net worth individuals pack their bags and transfer their residencies. Hundreds of thousands of the nation's brightest young minds head to foreign shores. Leaving one's motherland is never an easy choice. It is a profound, emotionally charged decision that requires leaving behind family, culture, social networks, and national identity. For generations, the emotional pull of home kept talent and capital anchored. But today, we are witnessing a painful tipping point where patriotism clashes with personal ambition and long-term security. The intrinsic motivation to leave is born not out of a lack of love for India, but out of deep-seated frustration with systemic friction. Beneath the headline economic metrics lies a deeper, entrenched socio-political inertia. Decades of systemic corruption, pervasive casteism, and persistent feudal dynamics allocate opportunity through political patronage rather than pure merit. Compounded by dynastic politics across the political spectrum and steady administrative decay, institutional trust is rapidly fracturing. At the center of this storm is a stark demographic reality. Millions of young graduates enter an economy lacking market-aligned skills. India is sitting on a social pressure cooker where unfulfilled youth ambitions and systemic bottlenecks threaten domestic stability. To understand this exodus, we must examine structural inefficiencies eroding optimism among wealth creators and youth. First is the burden of fiscal oppression without social security. High net worth individuals face top effective marginal tax rates approaching 39% when surcharges are included. Yet taxpayers receive virtually zero structural return on their tax dollars with no universal healthcare and minimal retirement security. This creates a persistent feeling of being treated as a revenue cow rather than a valued stakeholder. Second is the severe deficit in quality of life and civic infrastructure. Wealthy urban citizens pay high taxes while dealing with hazardous air pollution, failing urban drainage, public safety concerns, and overburdened healthcare. When daily life involves breathing toxic air and navigating broken municipal services, leaving becomes a fundamental family longevity decision. Third is the paralysis of judicial processes and contract enforcement. India ranks notoriously slow in global contract enforcement timelines, with tens of millions of cases backlogged. For entrepreneurs and investors, resolving a commercial dispute or protecting property rights can take decades. This institutional sluggishness destroys business predictability and drives founders to incorporate in rule of law safe havens. Fourth is the academic bottleneck and meritocracy deficit facing the youth. India's demographic pressures have created a hyper-competitive educational ecosystem where millions compete for a microfraction of seats in premier institutions like IIT, IIM, or medical colleges. Combined with complex quota dynamics and modest domestic R&D funding, millions of talented young professionals feel the system is rigged against pure merit, forcing them to look abroad for higher education and career mobility. Fifth is capital control friction and currency depreciation. Under the Reserve Bank of India's liberalized remittance scheme, outward capital transfers are capped at $250,000 per year, paired with a steep tax collected at source on foreign transfers. For tech founders operating in a globalized market, these regulatory handcuffs and steady rupee depreciation make global expansion from home unnecessarily painful. Data from the Henley Private Wealth Migration Report confirms this structural outflow. While India continues to generate thousands of new millionaires due to domestic economic growth, it simultaneously loses thousands of high net worth individuals every year. India excels at generating wealth but struggles with retaining it. When Indian ultra-high net worth individuals decide to relocate, their capital and assets move through well-established global corridors. The primary destination hub is the United Arab Emirates, specifically Dubai. Dubai offers zero income tax, zero capital gains tax, and seamless 10-year golden visas combined with proximity, just a short flight away from Mumbai or Delhi. Close behind is Singapore, functioning as Asia's premier institutional wealth management fortress. For those seeking deep capital markets and university access, the United States, the United Kingdom, and European golden visa jurisdictions remain prime destinations. Once residency abroad is established, the ultra-wealthy execute a clear three-step strategic playbook. Step 1 is setting up single family offices or corporate holding structures in tax efficient, legally robust jurisdictions like the Dubai International Financial Center or Singapore's Variable Capital Company framework. This legally insulates assets from domestic regulatory friction and currency volatility. Step 2 is aggressive portfolio diversification. Free from domestic capital controls, these investors allocate heavily into foreign real estate, global technology firms, Web3 innovations, global private equity, and US dollar denominated assets. This hedges their long-term family wealth against local systemic shocks and steady foreign exchange depreciation. Step 3 is securing multi-jurisdictional mobility. Through residency by investment programs and eventual naturalization, high net worth families acquire alternative passports or permanent residence rights. This provides frictionless international travel, access to premier global healthcare, and unhindered entry into top tier educational institutions worldwide. This brings us to the core policy question. Can India's political establishment realistically reverse this outflow of capital and brain drain? Whether under the ruling BJP administration or a future Congress-led coalition mandate, the core policy dilemma remains identical. Governments face a delicate balancing act. Domestic political pressures often demand visible taxation on top earners to fund social safety nets and infrastructure projects. However, overtaxing and overregulating wealth creators simply accelerates capital flight, ultimately shrinking the tax base the state relies on. Reversing the exodus requires structural economic reform rather than compliance pressure. First, India must rationalize its fiscal policy. Simplifying tax compliance, limiting administrative overreach, rationalizing high surcharges, and providing long-term tax stability would immediately reduce the incentive for tax exile. Second, capital control frameworks need to adapt to international financial integration. Easing friction around foreign remittances and modernizing the LRS framework would signal to investors and founders that capital can move freely into and out of the country without sudden policy hurdles. Third, India must aggressively upgrade its urban livability and technological ecosystem. Retaining young talent requires expanding high-tech R&D investments, supporting deep tech ventures, and directly resolving environmental and civic infrastructure challenges in major metropolitan economic zones. Ultimately, capital and talent flow to where they are welcomed and stay where they are valued. If policymakers prioritize wealth retention alongside wealth creation, India can transition from a global talent exporter into a premier global talent and capital magnet. Thanks for watching Talks with Dr. Gupta and friends. Stay sharp, stay informed, and let's keep analyzing the forces shaping our world.